Hello, 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 hello. What's going on, everybody? Welcome to Our Stock Trades. How's everybody doing today? What's going on? CLOV to retirement. I had a dream I could buy my way to heaven, but I woke up, I spent it on a necklace, right? I actually did something different. I woke up and I bought more Clover shares, right? What's going on, everybody? How you doing? How you doing? Oh, Mr. Jerry's in the house. First things first, as always, nothing we talk about constitutes financial advice. I'm not a financial advisor. This is an educational platform where we utilize and show you our software that I created. I coded with my own freaking hands, and we just like to educate. Now, Jerry's saying something really interesting. Your comment brought me to just remind myself of a video I made a while ago. Unfortunately, didn't get a lot of views, but it is what it is. Let's just go ahead and just play it. You're talking about how RGTI was on the verge of delisting, and then good news release, and then 3 months later, it's a 20 bagger. I want you to go ahead and pay attention to my face. I give a little smirk. Michelle usually calls this my player smirk, right? But just watch when I talk about RGTI. How do I know? How am I able to see into the future? Am I the Oracle? Am I? Free cash flow, still negative, a little smaller than Clover Health, but you can see the story continues, okay? Now, this is another one. This one I think is going to give you those 400 to 800% returns, most like 500. We'll see. Again, revenue, 1 million to 10 million. RGTI, it was less than $250 million in market cap, and we went ahead and spoke about it, and I said, you know what? This thing looks like it has the secret sauce of exploding. Well, ladies and gentlemen, it is now up 1,700%. Used to be up higher. Used to be up definitely a 20 bagger for sure. Look at that, right? Again, RGTI. Again, we don't like to talk about a lot of our winners. People always like to say, but the thing is, I've been doing this for a long time. We like to educate, stimulate, and inspire the next generation, okay? That's the whole point of this platform. Okay. But anywho, it is what it is. But let's see what's going on here. Finally, I'm in. What's up? What's up? What's up? Okay, let's go. Okay, ready. We're B-Rob. All right. Rigoretti, right? Oh man, you're like, man, I wish I got more of that, right? All right, so having a little regret. A lot to talk about in this video. I'm just going to kind of smash things through real quick. I went ahead and I wrote this whole thing. I recommend you read it. These are the payments for brokers commissions for 2026. You can see that the highest commissions in the nation is California and New Jersey. Cough, cough, Alignment Healthcare is in California. Cough, cough, New Jersey. Clover Health is in New Jersey. And you can see the rates are increasing more than inflation. The way how you read this is new Medicare Advantage members that age into it get $864 now, but renewals now, they used to get $390, right? Shout out to you, Master, right? But then now they get $432. So, that's pretty expensive. That's a lot of money. In fact, one of gentlemen here said, well, hey, Al, it's about $27 million to grow about 30,000 lives. And I said, you know what? Let's look at it a different way. You spend $27 million to generate around $450 million of revenue. And that's with a 3.5 star rating. Imagine when they get 4 stars, right? Next year. They already got it. It's just next year they're going to be paid for it. Looks like a flywheel business model to me, right? Now, here is, a more elegantly put summary of kind of this. I recommend reading it, but I quoted someone here, and I said, you think I work this hard to stay the same? And I quoted Tyga, right? So, you have to ask yourself, why am I have over 800 videos. Why am I doing this, right? Again, I'm trying to show you something, okay? I'm trying to show you something from an educational perspective. There's going to be people that, don't listen, and that's fine. You go to, I give talks at high schools. I give motivational talks, okay? And it's unfortunate because, there was an image that popped up that I shared with the group, about maybe less than 5% of people maybe less than a percent of people I speak to in high schools are going to listen. The rest are just going to end up being average. And some of them are going to go to prison. Some of them are going to die early. Some of them are going to, impregnate a new baby mama, right? Shit happens, right? And it's unfortunate, right? But the point is, I'm trying to, teach you guys something here. Okay. So, in terms of New Jersey versus California, there's a lot of competition in California. I mean, come on, it's California, right? New Jersey, there's the MA saturation is only 41% versus the state is 50%, the whole nation is 50%. So there's a lot of room to grow in New Jersey. And they've been kind of telling people this, but, just kind of going through over their heads. So I broke it down for you, and the big thing here is New Jersey is expensive in terms of the cost for commissions. And larger carriers, they're essentially pulling out and not only not offering MA to members, but they're actually stopping commissions. And you could kind of, I went ahead and I spoke about this here. And I wrote, this is an article that Clover wrote. It said, is your Medicare plan no longer being offered in New Jersey? Well, Clover Health is here for you, right? And then, you have these news articles I kind of just screenshotted. Avalanche, Aetna, Cigna halt broker commissions for Medicare Advantage, and United Healthcare cuts some of Medicare Advantage broker commissions. Well, guess what? Clover's still paying broker commissions. You get what I'm saying? All right. So there's that. Oh, great. Yes. So the House of Representatives Subcommittee on Health will be having a hearing entitled Examining Opportunities to Advance American Healthcare Through the Use of Artificial Intelligence and Technology. I've used Viz AI. It's like for the brain. Obviously, you guys know and all that stuff, right? So, I know this company. But one of the witnesses that's publicly traded here is Andrew Toy, right? Andrew Toy, right? Clover Health CEO, right? And I gave a cryptic message, and I want to just go ahead and just read it to you guys. Clover Health is speaking to Congress. This isn't theater. It's a signal. AI in healthcare is entering the bloodstream of the system. The policy people the policy nods, providers follow. Scale does the rest. Timing matters. Some of us don't wait for announcements. Checkmate is coming. Again, it's just Wall Street. Welcome to Wall Street. We operate in the background. I'm just showing you how it's done, right? You're starting to see the patterns, right? Retail investors sell, institutional ownership increase. In fact, I have something very special for you. So you know how part of the our software, and by the way, we're refreshing all of our software. You can see it's a new look. We're going to be refreshing this one soon. It's taking time because, again, we're really taking this to the next level, right? Just to give you an example really quickly. One moment here. As I find this picture. One moment. I'm building a rocket ship, right? In the beginning, I had to build it ruggedly, right? I had to make sure it works. It pulls the data, analyzes the data. Now what we're doing is we're perfecting it. Now we're making it look elegant, right? We're making the analysis elegant, right? We're having it beautifully be able to have the AI summary. It is becoming elegant now. We are perfecting this multi-million-dollar platform for lifetime access members. You understand what I'm saying? All right. So we'll talk about that. But I have something special for you because you remember when we spoke a while back ago, you can watch the videos from the past. We talked about analyst estimates, how our platform pulls from analysts cross-talking from each other. Well, let me show you something. You remember how in 2027, it was weird for 2027. They were, in fact, here, let me, that's fine. You guys can read this. In 2027, it was like a very positive number and a very negative number, and it canceled out. Well, I have something interesting. For 2027, they are assuming an average revenue growth of 23 million to around, I'm sorry, I read that, 23 million to around 67.5 million. So they're actually assuming profitability in 2027. And I found that interesting because they were like obscuring it. They were like showing a very high positive number and a very low negative number to cancel out the truth. But those analysts that were doing that were trying to manipulate the data, they didn't do it this time. In fact, they gave their own research. In fact, you have two analysts now providing this net income data. And it's interesting because that other analyst that was fudging the data is now telling the truth. And I'm curious why they're telling the truth now. And the only delta change that's happened is that institutions have been buying up shares. So could this be that they have bought enough to where now they are in a position where they want the stock to rise? Again, it's very interesting. And again, they were obscuring the data when the stock was falling. And now they're showing that they're going to be profitable in 2027. In 2026, we're still looking at unprofitability. But in 2027, we shift to profitability. In 2028 is going to be a holy Godzilla. It's going to be a Godzilla moment, right, in 2028. And so it's interesting to see this. They fudge the numbers up because they know someone like me is watching. And I said, that's interesting, right? So then I started calculating my own. And then the Part D drama came onto effect, which obscured the Q2 2025 results. But regardless, it's interesting because now they fixed the obscuration. If you go back to my old videos, you'll see it. I took a screenshot. 2027 was like positive 800 million, and 2027 for the high, and for the low it was negative 800 million. So there were two analysts. One analyst was obscuring the data. He was giving larger bounds, so it silenced the truth. But now he's giving you the truth. And I think it's because the institution in which he represents has collected all the retail shares that they wanted. So now it's time for them to ride. Does that make sense? That's my hypothesis, because it just doesn't make sense. Why would they obscure it and now they're not? I think because they're ready. And I think that, and it's funny that they unobscure it now, because a lot of retail investors, they think that, oh, we're at 40% or 39.5% of institutional ownership. But remember, guys, this is Q2. We haven't seen Q3 yet. In fact, we don't know. They've been selling, or I think they've been buying. So I think they've been buying a bunch of shares right now. And I think we're going to, who knows? I mean, I think we might be over 50% institutional ownership in the next 3 months to 6 months. And I think they're ready for the stock to rise. It's just a dirty game. I had a lot of people that were, I was seeing them. They're like, oh, I'm selling them. I'm like, all right, well, again, you're the CEO. You're the CEO of your own portfolio. We're an educational platform, right? Your teacher's not going to argue that you're not doing. Who cares? I mean, I at the end of the day, you do you, right? I mean, you could go ahead and go, I like buy some tomatoes. And invest in tomatoes. I don't care what you do. At the end of the day, it's just, I'm just showing you the data. We are a data platform. Okay. All right. So let me just go ahead and talk about this. So these folks are, coming in and they invited Andrew Toy to speak. It's tomorrow. We'll see what they say. But interestingly enough, it says here in both the calendar year 2026 proposed rules for Medicare physician fee schedule and outpatient prospective payment system. CMS is asking for feedback on how the Medicare program should consider paying SaaS and AI devices. That's interesting. Okay. Right. That's interesting, right? So, CMS is realizing that they want AI into their spectrum. The government needs help reducing costs. That's Trump's motto right now, is how do we stop spending? What AI healthcare application out there is decreasing costs by over 1,000 basis points? It's Clover Health. And now they are in there. You don't think, what's his name? Dr. Oz knows about this? There are a lot of people out there, oh, no one knows about Clover. Shut up. You don't know what the hell you're talking about. Go back to where go back playing in your sandbox. Okay? Let the adults speak. Okay? Let the adults speak. Okay? And just shut up and listen. God gave you 2 ears and 1 mouth. Shut your mouth and let the adults handle business. Okay? So we're starting to see, because, in the beginning I was like, well, they're going to get their money from hospital systems and Humana potentially, with the allegedly subdomain thing that, Rapala found there. But, I never thought about, I kind of thought about it, but I was like, well, it's a long term for me, 10 years, right? But CMS now is going to start paying, or is trying to figure out a way to pay programs that have a SaaS component. And if that's the case, holy shit, that means that Clover is going to be getting a SaaS revenue from the government. You know how they get paid from the government for CMS? You know how they get paid? Let's see here. Let's put this guy in timeout. Timeout. All right. So, you know how the government pays Medicare Advantage and they give around 80%, 85% MCR, and they have to spend that and then they get that money? Will there be an MCR restriction for the SaaS? I don't think so. I don't think so. That's going to be cold, hard cash, high margin. Holy shit. That could be injected in Clover. That is insane. I was thinking about this like 5-10 years from now, but they're trying to propose a rule for having this happen. And if that's the case, that means it gives an incentive for hospital systems to use Clover, which then the government will subsidize the hospital system for using Clover. Holy shit. Right? It's pretty insane. Okay? I'm watching this closely. Okay? Shout out to Rapala. Clover Health is using real-world applications. It's happening today. This is not I hope to do this. We're doing it right now. Okay? What else? CMS, again, we talked about this, about the payment methodologies. The Medicare Payment Advisory Commission, MedPAC, has described SaaS as an algorithm-driven software that is either cleared or approved by the FDA. Clover's doing it now to help practitioners make clinical assessments, including decision support intervention software, clinical risk modeling, and computer-aided detection. Right? Let's see. So there's that. Hey, I appreciate you, brother. It's unfortunate, but it's fine. Later on, once people see the beach house I'm going to buy, the water view, the money that's going to be flowing out of my ass and every orifice of my body, then they're going to realize, the truth of our platform, right? They're going to realize, and the $50 million real estate building real estate business I'm building. And at the end of the day, they're going to realize the truth, right? They're going to realize who the hell we are. Like, oh, wow. And then they might be haters, but hey, you know what? Hate. I love that energy. Your hate makes me richer. So keep hating, right? I make more money, right? So I use that as energy, right? I love haters. They feed me well. Moving forward, you see Vivek, he is the board member of ThymeCare. Clover connects with ThymeCare. But you know what's weird? On March 3rd, Humana partners with ThymeCare. Let's think about that for a second. Again, you could read this. The whole point is improved healthcare outcomes at a lower total cost of care. Big word here. Okay, moving forward. Like I said, the refrigerator made Coca-Cola $250 million business. The market cap of all the refrigerators in the world doesn't even come close to the market cap of Coca-Cola. Downstream technologies that are enabling, usually the downstream innovators outscale the model in which they came from. NVIDIA is growing the next AI revolution. Okay? Downstream products that are going to be in healthcare, business, or whatever. Clover is the AI leading healthcare platform. Once the world sees that, the intrinsic value will reset. Covered calls and cash secured puts are going to be so juicy. And we're going to milk them so good. We're going to milk these so good that, oh, Lord, you have no idea the amount of money, master the chin. You're going to be coming on the channel with a Rolex on your freaking head. On every little, you're going to wear 10 Rolexes on the left and the right of every extremity, even your fifth extremity, right? I'm telling you, man. Okay. All right, so this is going to be great. It's going to be very exciting to see this. Sellers now are getting a taste of their medicine. They're real. You've seen it on Zillow. I mean, I've been watching it because I'm in the real estate market, right? I'm building my real estate company. So in 10 years from now, when I offer you guys mastering the real estate course, and I am going to be building software for that too, you guys are going to know that I'm truly a master. Again, I don't call it a master if I don't have at least 10 years of experience. I don't right now. I'm actually learning from my future father-in-law. Let me show you a picture of him. Hold on, let me show you a picture of him. I just gotta find it here. Hold on. There it is. This is Michelle, my lovely Michelle. This is her dad, Ferris, right? I'm learning from him. There's his nice cigar. I don't know what kind of cigar that is, but I'm learning from him. I'm learning how to build a real estate company, right? Okay. So soon enough, there's going to be a lot of money backing this up. So it's going to be very fun. All right. So we talked about this. We talked about a lot of these sellers are getting new agents after 4 or 5 agents trying to see if they can sell their house $400,000 to $500,000 above asking price. And they realize that they can't. And now these boomers are about to eat shit with their hands. Okay. And then you boomers that have been eating up all the pie, I'm going to come to you and you're going to want to retire. And I'm going to offer you cash and you'll take it. You'll take it like the person that you are. And then I'll be able to build my empire. You understand what I'm saying? Now, next title. The huge opportunity to use technology to bring great healthcare to more people. Interview with Clover Health's Andrew Toy. October 14, 2021. Scrolling down. Here, it talks about the reason I didn't found a technology company or SaaS startup is because it was hard to do it in healthcare. So what we did is we said, let's build great technology and move it into building a managed care company. So what Clover did is said, we're going to become an insurance company. And we're going to but we're going to implement Clover within this company. And as these doctors use the data, we're going to take that data and we're going to build off of it. And they've been building off of this data since 2016, 17, 18, 19, 20, 20, 2021. While the rest of the healthcare universe was sleeping, these people were building. So going back down here and going down here and reading and highlighting this, I think people in that retail environment support and are willing to believe and bet on a grand plan. They want something audacious, someone who's going out there and saying, we're an incredible $150 billion company. They see Clover as being different, and we are different. That's a great thing, as opposed to when people say, oh, you're just a Medicare Advantage plan. No, we're not. No, we are not. They are not a Medicare Advantage plan. They are an AI play in healthcare. They've always been an AI play. It just so happens they're damn good at being a healthcare company too. Okay? So it's tick-tock, guys. Tick-tock. Little by little. Little by little. Tick-tock, tick-tock. The alarm will sound. And when it does, it's going to be very beautiful. Okay? And to the person who's teaching me real estate, I am going to kick your ass. I'm going to kick your effing ass, right? Yeah, I'm very competitive, right? The wealth that you built, I'm going to kick your ass, homeboy, right? But he did teach me a lot. But I'm going to kick his ass, right? I'm going to kick this guy's ass, right? In a respectful way, right? I always tell him this and he says, I know you will. He's too nice, right? But I'm going to kick his ass, right? All right, so why am I so okay? So Clover was able to understand that it was hard to build this at Google. So what they did, and by the way, he has a strong connection to Google. Google's watching right now, just letting you guys know. Okay. Amazon, Warren Buffett, and JP Morgan Chase partnered to create Haven Health. And it failed. They wanted to create an AI startup to cut healthcare costs. Imagine, these are trillion-dollar companies like, Amazon, right? And they want to build something like Clover, right? And they failed. And now Clover is succeeding. Clover is one of the only ones. Is the only ones. What do you think is going to happen once the market wakes up? It's hard to see it this year. Last year, we saw a great movement. But this year, United, they're all down. What do you think is going to happen when the J curve starts? Right? We're right. And you know what a J curve is, right? Let me teach you. This is a J curve. So folks that don't know, we're in a J curve right now in accordance to Humana. Okay. We're right here right now. We're in the J curve, right? Last year we were below the J curve, but now we're in the J because now we're following all. We're United and all. I think we're right here now. I think we've removed ourselves from the bottom. We're here now, okay, with United, Humana, and all of them. I think in the next couple of years we're going to get to that J curve. I always say 2028 and beyond. Okay, so think about that. I want you to think about that. Okay. Really, really think about it. Okay. This is long-term, right? There is a lot of people that unfortunately, if you look at all the greats, let's look at Amazon. There are a lot of idiots who sold during this region, and now they have to live and watch their failure here, right? That's Amazon. Let's look at Apple. Look at all the idiots that sold here. Whoops. Let's look at United. Look at all the idiots that sold here. Look, Nvidia's funny. This is Nvidia. Like literally 18 years. Look at that. Look at all the idiots that sold here. Right? And later on, in about 10 years from now, I'm going to say, look at all the idiots that sold here. Look at all the idiots. And again, it's fine. This is not financial advice. You can sell. I have the freedom of speech to call people idiots. There's going to be a lot of idiots, but it's okay. Because the idiots that sold, I bought their shares. So thank you. Thank you. You pretty much donated me your money. Now get back to your W-2. Go work your job as I enjoy your beach view. I'm going to enjoy the beach view. I'm going to enjoy the view, right? Thank you. This here. Whoop. Let me go here. This right here, guys. This is your view. Thank you for giving me your view. Thank you. I appreciate you. I love you, right? Thank you, right? I'm speaking from Wall Street. I'm showing you how Wall Street looks at you, right? Thank you for helping us. Thank you for but we need you. Go back to get your W-2 so you can buy at the top, right? Because we're gonna get no. Better yet. Here's a good one. Go back to your W-2. Go work hard, right? Go work hard. And go buy some calls, right? Buy some calls so you can donate your money to us, right? Go gamble, right? Go gamble. Go donate your money, right? I will be selling you your dream. I will be selling you your fake prophecy, right? You're through the vehicle of covered calls and cash secured puts. I will be giving you this false dream that you're, when you tuck your head in bed and suck your thumb and you close your eyes thinking of a better future, I'm going to be milking that bullshit that's in your head, right? Because there's going to be idiots out there that are going to come in 5 to 10 years from now. And when you come, I will be waiting for you. I have planned for that day. I will be waiting for you. And all of our Lifetime Access members will be waiting for you. Right? You are the vehicle to our American dream, the vehicle for our generational wealth. We need NPCs. You are just here to stimulate the player characters that we are. That is your only mission in life. You are an NPC. Your job is to enhance people like us, people that play the game. So go back and work in the Matrix while we go enjoy this view and enjoy Mother Earth, right? Right? Damn, Al, you're harsh. I'm just showing you Wall Street. I'm showing you how these people think. I've been in these tables. I know how these people think, okay? This is, again, guys, listen. This is not a channel like the others. Okay, I'm not here to make friends. I'm not here to garner likes and like this bullshit and subscribe. I don't give a shit. I'm trying to teach you a lesson. I'm trying to teach you something so your frontal lobe can actually build some stupid synapses. Okay? You understand? I don't give a shit if you like this video or not. At the end of the day, I'm fucking making money. I don't give a fuck. You understand me? I'm trying to teach you, and that's it. Some of you will not listen. Go back to your W-2. Go do that because we need people like you, right? While I go ahead and enjoy your view, right? This is your children's view, right? Thank you, right? Your children will be working W-2s because of you, right? Mine won't. Mine will be sitting here watching, right? And if you get upset, I'll have security outside with some nice guns, right? If you want to do anything about it, if you get upset. You understand what I'm saying? Welcome to Wall Street. Welcome to fucking Wall Street. We're not here to play games. We're here to make money. You understand what I'm saying? All right. So, and if you're out there and if you want to join us, here's your path. All right. So now that we went ahead and we spoke about this, now let's go ahead and let's take a break. And we're going to talk about some of the institutional graphs here. Okay. Because there's actually something really interesting that I want to mention here. So let's take a break. I'm gonna go drink some water. Okay, right? Yeah, B-Rob. I told you I'm harsh as hell. Right? I mean, this is I'm just showing you how these people think. Okay, this is how they are. Okay. All right. We'll be back soon. We're gonna take a little intermediate break. Hello, hello, hello. I'm back. All right. So, what we're going to do right now is we're going to look at the institutional ownership. Okay. And I pulled it up here. This is really cool because we're able to look at it from the short range perspective and then look at it from the long range perspective. And then we can also, open up the graph and zoom in on it and then zoom in here with the cursor and kind of scroll, pan out left and right to see what's going on. But what I wanted to do before we do that, before we look at Clover, is I wanted to go ahead and look at SoFi. Okay. And I wanted to pull SoFi and have that grab the data. I'm going to score it. SoFi is a bullish score of 7 and a bearish score of 2. You can see it here. Again, you can see the user interface is unlike anything other. Again, I'm showing you a multi-million-dollar platform here, okay? You're starting to realize kind of, where we're headed, all right? So if you go down the total invested, I strategically made this graph the way it is, almost like a integral technical analysis, and the way it's organized, right? So you can see in well, first off, let's remove let's remove this here, and let's remove this. Let's remove that. Okay. This here, blue line, is the total invested. These are big dogs, right? 1 billion, back in 2022 Q3, when everyone was crying about SoFi, big dogs had about $1.65 billion. Now big dogs have $10.48 billion. Now, if you add the simple moving average, you could see that there was a, hold on. You could see that there was a change here where things started to break out, right above here, right? We dipped, but then we recovered. And then now if you look at the stock price, you could see the stock price starts to merge in with total invested. It starts to merge together. You get divergences, and usually these divergences are opportune times. And sometimes you get an overvalued divergence here, but it corrects. But you can see how the total invested in the stock price kind of fit in together like a glove, right? Let's go ahead and take a look at another one. Let's take a look at Tesla. And the cool thing about this is this beautiful drop-down menu comes. You can click on it. You can do what the hell you want with it. You can score Tesla, right? You go back to total invested, and you could see this gloving pattern, this beautiful gloving pattern that you can analyze here. And you could look at the long range of Tesla, and you could see how in the beginning, when the stock price was $12, you could see this gloving sensation, right? Again, you could see this beautiful gloving sensation, right? How it just fits like a glove. And again, I want you to pay attention here. Watch this. I want you to pay attention here. Let's go all the way back. And again, you're not going to find this data anywhere else. Who the hell has institutional ownership data from 2010 or let alone 2001? We have it. That is the power of the Al Stock Trades platform. Look at the beautiful gold here. This is the product that you can get right now, lifetime access, right? For a very cheap price. So, you could see the stock price for Tesla was around $1.50 to $1.70. It goes down to actually $1.30, right around here, $1.36. Cheaper than Clover right now, right? So you could see as, we scroll to the right, you could see how institutional ownership starts going up. So does the stock price. Sorry, I'm total invested from institutions, and you could see what happens, right? You see how it almost fits together like a glove, right? So I'm just going to keep scrolling. I just need you to pay attention to the y-axis here, right? This is the stock price. That's why it's yellow and this one's blue, right? This is the stock price. And just pay attention to the y-axis. See how it gets larger as the total invested gets larger here, right? Market cap is small here. We're talking like, less than $2 billion market cap, right? You see all of a sudden now it's a $50 stock price. You could see how it moves in tandem. You see that? You see that? Look at that. Here you got a divergence. Stock price went up. Institutions blue went up. Stock price went down, divergence. Oh, they converge together. They fall together. They ride together, bad boys for life. You see that? We went from $1 to like $300-$400. You see that? Let's look at Apple. Let's see if Apple does it. Oh, here's Apple. You could see how it fits in like a glove. You see that? And it's funny because Apple always trades at a premium. You could see that right there, right? And you could go long range for Apple. You do long range. Okay. Here's the long range. You can zoom in all the way down here. We go back to 2000. You see this gloving interaction? This is when Apple was 32 pennies, obviously pre-adjusted. But you could see the market cap of Apple, the total invested from institutions were about $15 million, less than freaking, Clover Health. Look at this gloving pattern. You see how it's $1.80 now? You see the gloving pattern? I'm going to keep going right. Now we're in 2009, $10 stock price. You see the gloving pattern? You see how it just, sometimes it diverges, but it ultimately gloves back. The blue and gold line, the stock price and total invested. There's a gloving sensation. There's a gloving pattern. Okay? Look at that beautiful glove. You see the gloving pattern here? So then now let's look at CLOV. Let's go ahead and do the long range and let's look at Clover. That's weird. Clover, for the past many years, look at the stock price. The blue line is up here and the blue line is up here and the stock price is down here. There is a huge difference in divergence here. Why is it not gloving? It used to be gloving here. There used to be some gloving action here. And that's because institutions were net positive of the trade. Institutions, if the stock goes up, institutions win. But then institutions left. Then all of a sudden, you zoom in, and then institutions started piling on. And then you started getting an over divergence, an over gloving effect. Right? And then right? So then you zoom in. Let's zoom in. So then institution total investors started going up. But then something weird happened. Something really weird happened. The stock price goes down, but yet total invested goes up. What is this divergence? Right? What does this mean? It means that I think it's gonna kind of to me, again, not financial advice, but to me, it kind of looks like down here. This is going up, this is going down, so it's going to eventually end up going up. So there is that. But here's the problem. Okay. Problem is it's hard. It's hard to take all this data and be able to analyze it to, see this divergence. Like, why is there a divergence here? Right? The institutions are buying. Now this is number of 13F shares, the number of Clover shares that big dogs are buying. So why is it that it's going up, but the stock price is going down? That's a divergence. Okay. Now, what's interesting is the stock price ended up going up. If you can't see it from the data here, but if you were to hit the analyze button, which does complicated statistical analogs and methods. It shows you its findings and its research, and then there's this generate AI report that is fast as hell. You know, but what this tells you is a story. Sometimes these are kind of all the data pre-metric analogs, and this breaks it down in, you know, basic English for normal folks. This is for our math nerds. This is for our normal folks here. But what's interesting, if I may say, is when you have a negative number here, it shows you that price leads. Here is called the metric leads, right? So what's interesting is that this shows you that there was a 3/4 to 1/4 lag for institutions, right? And what that means is institutions right around here, the stock price went up, but institutions sold. There was a divergence here. There's an X. There's a divergence. But normally this is bad for retail investors. But something happened between Q1 and Q2 last year. They became free cash flow positive. In fact, Q2, they were profitable. And Wall Street wasn't expecting Q2 to be profitable here. They weren't expecting it. So as soon as that happened, the stock price exploded, and then institutions had to catch up. They had to catch up. And institutions don't like that, right? They don't like this game. They hated this because then, you know, Vivek bought, then he bought again, and all this bullshit happened. And they're like, man, this is some bullshit, right? They don't like that. They don't want that, right? Because they were able to miss the jump. Retail caught the jump. So I think there's some shenanigans happening now. They're trying to get them to sell, and you know, they can't catch the whole move, but they're catching the move for sure. They're going to be catching future moves now. So if we go to analyze now, you could see these concurrent analyses. You see 1, 2, 3, 4, 5, 6, 7, 8. 8 concordant surges where it shows you if it's a leading indicator or the same time it happened. So let's look at the one that's leading. Let's look at a leading indicator. So I don't know. Let's look at these two things. So for Clover Health, if the total invested year over year, it jumped to 219.1% in 2024 Q4. The price action in Q1 jumped to 352.1%. That's a 1/4 lead. Same thing to this. So what this tells you is if you look at the total invested, as it jumped, the stock price ended up following suit. So what this tells me is as this goes up even more, and we know it is because look at the number of shares. It's if you look at let's look at the history. If you look at the history of Clover Health, we are about to get to a level higher than what we have gotten to since 2021. Right? Again, this is old data. I mean, it's old data. It's three lines with a whole bunch of support from institutions here. Okay, so let's take a look at, I don't know, SoFi. Let's take a look at SoFi here. You can also somewhat see, let's look at the 25-year analysis. Obviously, I haven't been 25 years, but you could see how the stock price follows pursuit, the way it's structured here, the way I structured the analysis here. I mean, it's interesting how Let's look at Tesla. Let's look at the 25 years. You could see how these graphs end up also fitting like a glove as well for the number of 13F shares with the stock price. So if you go back to, well, let's look at Palantir. I'm curious. Palantir is a good one, huh? Let's look at 25 years. Obviously, it's not been 25 years, but it just gives you the whole picture. You could see how there was a big divergence, and all of a sudden, you're starting to see it. It's starting to fit like a glove. Same thing with Palantir. All this was undervalued. The stock price was under the total invested, and then it basically started fitting like a glove right around Q3 to Q4. And that was right after they became a triple dragon, and all of a sudden they started formulating and going to the moon, right? They were going to the sky, right? So if we were to go here and go to CLOV and go long range, you could see that there's a huge gap here. And it's looking like, $10, $12, $14 is looking pretty sexy. So the question is, when is that going to happen? One of those days going to happen. When is it going to happen, right? So let's go ahead and load the normal, because the least amount of data we load is better, because it's not going to load the past 3-4 years of just shit, right? And if we were to analyze this and then run our generate insights, we can generate insights in real time. Again, this is all part of our lifetime access. If you want to be a part of this, you get access to this software. There's nothing on YouTube, and there's nothing out there that exists that has this information. Okay? We're the only people out there. How do I know that? Because I just freaking created this. I've been working on it for a couple of years, but I just created this. Okay? This is my software. Okay? So if you want access, it's here before you get priced out of it. Okay. All right. So you could see here, investor holdings, number of 13F shares, ownership percent, total investors. It shows you the math. Like, it tells you kind of the wording, but then it gives you kind of in plain English. Wait a minute. Hold on. Hold on. Man, hold on. Hold on. I just got to check something right now. I need to make sure. Again, this is the... Yep. Sometimes I hate my life sometimes. Okay, hold on. Give me a moment. Let's see. I found there's a little bug here that I need to fix. One moment. Rising investors holding indicates strong institutional sponsorship. Sustained increases are often constructive. Rising total investment indicates strong institutional sponsorship. Sustained increases are often constructive. It's fine. It's not that big of a deal. So on future update, you could see this beautiful little gold scroll bar. That took like an hour and a half. I'm going to be adding to the generative AI. I'm going to be adding another line down here just to summarize a little bit better. But this kind of gives you an idea. Let's look at total invested. Again, as you guys can see, this is kind of how I am. I talk to myself when I'm like offline. I'm like, oh, you freaking idiot. Oh, you should have, because, this is, I'm coding and I'm just kind of, sometimes I'm like, so it's, everyone wants to be a founder, but this is like tough. This is very hard. It's not easy. I think this is harder than medicine, to be quite frankly honest. Medicine is a path that they give you, and you just follow the pebbles and eat the kibbles along the way, and you follow them into the sunset. There is no instruction manual to this. I'm making it all, and I'm making it, right. So it's hard, but okay. So total invested. So plain English wise, well, first off, this shows you all the reported institutional positioning, right, for Clover, right? So you could say when total invested jumped year over year above threshold, the stock often rallied within the next 2 quarters, typically around 0.5 quarter median change around 352%. Biggest example was 2024. You got Q3 price and then it went up, right? So this kind of analyzes the data for you, and it just kind of figures out, and you could change the metrics on how it is. I'm actually happy with it. I might add a little bit more, breakdown. Again, I like to find a way to be able to break this complicated information down to just plain English, to where someone without a college education is able to understand it, right? And frankly, people that go to college, I think are not as smart, to be frank. If you go to someone who went to college about 50 years ago and compare them to now, I think there's been a dilution in our educational system, but I digress. So by analyzing all this data, it goes in and creates a forward projection of what the price could be. And it shows you in a year from now, 320, 3 years from now, 421, 5 years from now, 496, 10 years from now, 665. And again, you might ask yourself, you might say, whoa, wait a minute. Hey, this sounds a little too low, right? And it's because it's taking in the data of garbage from the past. In fact, if we do a long range analysis and get the longer range model since 2019, 2020, whatever, and we were to analyze that, the AI, what it's going to do is going to analyze all that information. So now the 1 year target is 297, 3 years, 335, 5 years, 379, and 10 years, 511 versus the other one was 6 something, right? So the point is as we get more quarters under our belt, and we just got back into the Russell, all that institutional ownership is going to be basically cycling in and washing out all the bullshit of the past. And then there's going to be a proper evaluation, I would say here. Again, these are probabilistic, they're not guarantees. Which is why it goes back to intrinsic value. You got to look at the intrinsic value, and you got to figure out, what could be the intrinsic value. And we're going to go ahead and do that on the next phase. But, what I wanted to show you just really quickly is if you go to SoFi, and if we were to just go to analyze and then generate the insights here and have it pretty much basically analyze all this in real time, take all that data and make something useful out of it. And if we were to scroll down, you could say the 1 year target's 21, 3 year target's 31, 5 year target's 37, 10 year target's 50, right? And this is for SoFi. So you could see how it can become quite interesting, right? And then you could do the same thing with Oscar. I'm sure Oscar in the future is going to look pretty sexy. You go ahead and look at Oscar. Look how it's fitted. You look how it's fitted like a total glove, right? You see how, now again, I'm not going to be showing this information in the future because this is going to help me do covered calls and cash secured puts, right? And again, this is not financial advice, but I'm just, this is my edge. I'm sharing it with all of you guys. You can get access to it while you can, but I'm not going to be putting this online anymore because, I'm building the real estate business. I need to milk my I need to milk my covered calls, right? So the question is, you can see here, like right now, if we were to zoom in and just kind of zoom in here, you could see that, and again, we can zoom out actually for a sec. This is great because you could say, well, I'm going to do my covered call right now at 22 or maybe at 20 because I think it's a little overvalued because institutions are down here for total invested. So, it's falling. So, right. So you could see how like right now I would do a, lower covered call to make money. Obviously this is going to be updating soon. It hasn't been updated yet for the price. And soon I'm going to have I just need to put a couple codes in to figure it out. But you could see how this tells you at is this an appropriate price? Like is Oscar at an appropriate level? You could see institutions right now are around $16 to $18. That's kind of the area the blue line is in, right? So if we were to go to Oscar right now, and you could see, let's look at the past month. You could see, $17, $18. You could see it's been going through $16, $17, $18 right here. Right. So that's kind of where it's at. Now, if we were to go ahead and go to, CLOV, and were to go long range, you could go ahead and zoom in here, or just go like this, because if you go like this and zoom in, it's hard to visualize it. But if you look at it from a long range here, you could see how the delta is pretty big. So I don't want to do covered calls, right? But before, the delta wasn't that bad. I was like, oh, okay, we can go. And then I mixed it in with intrinsic value, which showed me that there was some overevaluation for Clover here. It was overvalued. So I risked about 25% of my position doing covered calls, and I was milking and making $40,000 to $50,000, sometimes $80,000 a month. Object here is saying, the premiums, there's no premiums now. That's because we're on a downtrend. You technically can get premiums at, I think that's paying 5 cents, which is nothing. I would not do that for $3 or whatever, like 4 weeks from now. I again, not financial advice, but I'm not doing that. But what's going to end up happening is, if you don't recall, the premiums when they were here, again, you see how I'm using a different software now? I'm using the intrinsic value. You see how it's like an onion, right? You use multiple levels of data, and they all stack up on top of each other to formulate a picture that is the holistic picture that shows you where it's at. And it kind of, you put that all together versus some idiot on Robinhood who just has a picture of his phone of the stock price and his, finger up his ass. You're gonna win, right? You're gonna kick that person's ass, right? So it's pretty cool. You go highlight over this and you see how it kind of glows. Yeah, that took like 40 minutes to make. Yeah, just little tiny things that I added. I made this one not disappear because you can tell there's more up here and whatnot. You can see just beautiful. Just look at the interface here. Like, oh man, so freaking sexy. But yeah, so there will come a time where we will. I think it's going to go up higher, and then the premiums will come back. But you can see from this perspective, from this long range, I can't really muster myself to do a cover calls, because I think that we're going to get to this level soon here, right? And if we were to zoom in, we could see that there's a divergence now, and a divergence is starting. Okay, so there's that. Oh, what else? So I think there's there's that. So now let's go ahead and talk about these 8Ks. So here's the cash flow statement for the fiscal year of 2024, 2023, and 2022. The operating cash flow here is $82 million. This is discontinued, so we're not going to see this year. But the big thing here is unpaid claims. It added $19.2 million to the $82.45 million. So I would say that unpaid claims, again, I don't know what it's going to be this year. I think it's going to be 0. I don't think it's going to be 19. But it used to, they said they're going to have a normalization of their unpaid claims. So I think we're going to get back to, we can say 0, right? I think we're going to get back to 0. So to properly do this, I would say we would have to take 82.4 million, subtract 19 million. But the problem is, I don't think Clover is going to lose 43 million this year. I think they're going to lose more. I think Clover is going to lose more money this year. Okay. The question is how much more money, and that depends on Part D. It's tough to say. Granted, now that institutions have been buying up Clover, I think that if you look at analyst estimates, again, you see how beautiful these graphs are. This will be updated with statistics and a bunch of crap. This will be updated soon. We're updating our whole mainframe, okay? All this will be updated. So when you do like price targets, you're going to see the price targets here. All this will be updated. It's going to look very sexy. You're going to look at the support and resistance lines, Fibonacci's. All this will be upgraded. It's going to look very sexy. Let's open up analyst estimates here. If we look at revenue, you could see that this year they're thinking 1.8 mil. Next year they're thinking 2.4 mil. Sorry, 2.4 billion. I think it's going to be higher. But look, they're thinking 3.6 billion in 2029. That's pretty big, right? That's a big number, right? That's billions of dollars in revenue. I think it might be higher. We'll see. It's going to be higher than what they were with their direct contracting, which is going to be quite funny. And by then we'll have SaaS revenue, and who knows, the whole House of Representative things. It's going to be interesting to see that one with its SaaS revenue come into play, right? But later on, we could calculate the revenue growth rate here, but I think it's underestimating, and I think it's going to be a lot higher. For Clover, I think they're going to lose around 57 to 54 million dollars this year. Let's just take the worst number. Let's say 57.5. Okay. So let's do that. 57.5. Okay. So to find the difference, we have to take 43 million. Okay. And then we take 57.5. Sorry. Something flew in my mouth. So you can see here that they're going to lose 14.5 more million dollars this year. At least that's what analysts are expecting. We'll see, right? So with that said, how much money are they? What's going to be the operating cash flow here? Okay. So to do that, we're going to take this number here. We're going to subtract unpaid claims. Sorry. Unpaid claims is here. We're going to add it to this number, 14 million, but we'll turn it into like this. Okay. And I think that should be good. I think this year they're going to have about 48. Let's divide by 1,000. I think they're going to have 48.6 million of operating cash flow this year. Let's take a 25% cut. So let's say 75%. They're going to have 36.49 million of operating cash flow this year. I think that's what they're going to get. Right? They could get 48.6. That's good. But I would say 36.49. That's kind of what I'm expecting. We'll see. 36.49. So if we do that, to the intrinsic value here, and if we go here and put the 36.49, the question is, what's going to be the growth rate? I think Clover's going to grow more than next year, but just from the purposes of just today, This year, they're growing around 37%. Last year, they grew 9%. Divide by 2, that's 23%. So you go back here and you do 23%. You do that, you get a base case of 289 and a best case of 416. So if we were to zoom in here, we could see that we're at a level that undervalued here based off of the intrinsic value. So that's kind of what I'm expecting. But here's the thing. This is a bit low, right? And the reason why it's low, it goes back to net income. Net income is negative right now. And I think this year it's going to be a higher negative. If not, holy shit, that's going to be good for us. But I've made it a more negative number. Remember, 55.7 million? I added another negative. I removed another negative 14.5 mil from the operating cash flow because I think they're going to be more negative this year, right? Still not as bad as 2023, but the question is, when are they going to be break even? Or at least, a lower negative number. Well, we go back to this graph here and we go back to net income. And we could see that next year in 2026, Wall Street is expecting them to lose about 24 to 26 million. So let's go ahead and now let's take 26 million. So let's go ahead. So we said, we said 55.7 mil. So let's just redo the math here. So we'll do 82.45. Mm-hmm. Subtract the unpaid claims. We're going to zero this out because they're not going to have that anymore. So we're going to subtract that, right? Okay. So once we do that, we get 63 million. Okay. So let's put that there. But now, if next year they're going to lose, what do we say? 20 something million? What was it? Next year, they're going to lose 26 million. That means it's no longer they're going to be 43 million loss. So to find the difference, you just take 43 minus 26. So that means, or better yet, let's just make it easier on ourselves. Let's add 43 million back. So let's add 43 million. That'll bring us to 106 of operating cash flow. But remember, we're going to have to remove 26 million because next year they're still going to be unprofitable by 26 million. So that means next year's operating cash flow is going to be $80 million. And that's going to be so freaking sexy, right? Unless they lose more next year. We'll see. But Wall Street is thinking not. And they are going to be paid 4 stars. So let's update that now. Let's put 80 million now here, right? And 23% because, we're averaging and maybe next year we'll get the average for next year's growth rate. But let's keep it at 23% because I know they're going to grow. This is going to go higher because I think they're going to grow more next year because of what we talked about regarding the commissions, how other companies are pulling out. They're not paying commissions. But let's just assume 23%. It's only going to get better, I think. If we hit enter now we see a base case of $6.34 and the best case of 9. So you remember how it was trading at around the base case, a little lower now? So next year we should be around $6. And if you look at the covered calls right now for next year, the $7 covered calls are paying. So it's quite interesting. Someone's doing the math, right? So then now let's do the math of 2027 when they become profitable. So in 2027, Wall Street is thinking 67 million. So 67.5. Let's look at the low one here. They're still thinking they're going to lose money on the low end. But less money. But if they are, let's use the profitable one. So if there's $67.5 million in profit, let's go ahead and use that, right? So let's use this number, 82.4 million, whatever the number is here. Let's subtract unpaid claims because that's going to remove it, right? You're going to get 63 million. Let's add back in the 43 million because that's going to make him break even. We're adding that back in because this removes from this, right? So we're adding it back in. We're going to have 106 million. But guess what? Now we're going to add back in 67.5 million, right? So now we're going to add another 60, what was it again? 67 or 65? Let's make sure. 67.5, right? So 67,500. So now they're going to have 173.65 million. Let's go ahead and let's keep the growth rate the same because we're trying to be conservative. So by doing that, we got what? 173.65. By doing that, we have $13.76 to $19.81 for 2027. And I think this growth rate is going to be a lot higher, but let's just keep it low, right? We will adjust it later when the time comes, right? And I'm going to do it more internally. So my covered call actions will be good, for myself, right? Again, it's educational. So then now let's go ahead and take a look-sees at 2028. 2028 from our software, they're thinking net income is 141 million, 0.89. So they're thinking really positive. There's not a lot of analysts here. That analyst ends up dropping off. There's only one analyst. This and then this one analyst here, and then it's weird, right? So they're not really extending it that long. They're not even going to go that far. But 2028, 141.89. So if that comes true, all you got to do now is just replace this. 141. What was the number here? 894. By doing that now, you're going to have $248 million in 2028. So 248. Now, again, the growth rate is going to be a lot higher, but let's keep it 23%. Let's see what we get. A base case of 19 and the best case of $28.29. You see that? So again, and I know I'm like, oh my God, I don't believe this. Okay, that's fine. You don't have to, right? I'm just going ahead and showcasing you this. So later on, the next next 3 to 5 years, once you see me, have money coming out of every orifice in my body, you can see how I did it, right? You can see it, and it's right here. And here's the videos of over 800 videos that we made, and you could go ahead and take a look-see. You can look at the market cap, and these are the future market caps of what I think is going to end up happening, right? So it is what it is, right? So with that, it'll be interesting to see, okay? But that's 2028. But again, remember, this does not include SaaS, and this does not include the growth rate of more than 23%. Now, again, if they somehow pull off like an Alignment Healthcare, which, again, we did the research and we found that the penetration of Medicare Advantage in New Jersey is only 41%. They have a lot to go. They have a lot of ways to go versus California. So I would say, in 2024, they grew 9%. This year, they're growing 37%. Let's say 2026, they grow another 37%. Let's just say 23. So, okay, hold on. So this year, they're 2025, 37%. Let's say 2026, 37%. Let's say 2027 is 30%. And let's say 2028 is 25%. I think it's going to be higher, but let's just use these numbers. There's 1, 2, 3, 4, 5. 5, so divide by 5. That's 27.6%. So let's use this 27.6%. And there you have it, $26 to $39, right? I would say in about 5 years, right? But again, not financial advice. This is just educational. I'm just showing you what intrinsic value is, like what are how these people do it, right? So, but again, let's just make it simple, 23%. Right now, they're not at 248 million, but you can see based off of these analysts, that's where they're headed. Today, as of right now, what Wall Street's thinking, based off of let's look at the 8K. They're thinking 80. They're thinking 82. Let's go back to reality for what we are right now. 82 subtracted unpaid claims, right? But the problem is it's not going to be 43 million. It's going to be like 55 or 57 million. So let's subtract another 14.5 million. That's at 48.6. So we put 48.6 here now. And you could see, 286, 385, and 554. So the question is so we're technically at the bear case now, but like, what is our reality now? What is it now? And hold on. I remember so 48.6, but we divided by 1,000 to turn it into millions, but then we shaved off 25%, right? So that's 36.49. So let's put 36.49. So if we did 36.49, there it is, 289 as the base case. So as you can see, if we were to go here and go CLOV and look at we go to free cash flow, 33.29. So we could just honestly use this number because that's what probably Wall Street's using. We'll go ahead and do this, 32.9. And there it is, 264. See? And it's currently trading at 269. So what is it currently trading at? $2.69. See? So all I did is it's not that hard. Let's look at it. What is it today? All I did was I took last year's growth rate, which was 9%, and then this year's growth rate, 37%. I found the average. I put 23 using our software. And all I did is I took last year's free cash flow, which was here, 2024, 33.29 million. And I just put it here and I pressed enter. And then I got $2.64 as the base case. Okay. You could see as soon as it basically touched, it went up, right? You could see the undervaluation here, right? So the question is now, when is this number going to go up? And it's the free cash flow has to go up. When will the free cash flow go up? Well, the net income has to go up. When will the net income go up? When they become 4 stars next year, right? When the unprofitable new members this year age into becoming profitable members next year, right? So you can see how this works. And people are like, well, your price target was this and that. And that. Dude, it all goes back to free cash flow. Don't be stupid. It all goes back to the free cash flow, right? And is free cash flow gonna go higher, right? So this auto populates you can put the stock price as 0. Well, I guess you can't. You can put the stock price as like 20 cents. It's still not going to change the price target, right? What changes it is these numbers, right? But this auto populates the price. This auto populates it, right? But what do we say? The average cash, we took this number here, 33.29. And we took the average 23%. And this is where we're at right now. So we're trading about 5 pennies away from the stock price, right? I think it's better to fill in the numbers yourself. Beautiful part is you don't have to fill in the outstanding shares, and you don't have to fill in the stock price. That does it automatically. But you need to know these numbers, I would say, right? You need to know these numbers, right? And you can look to know these numbers. It's not, you don't have to go far. You can scroll down. The numbers are here. Actually, I don't know why I'm going here. It's a habit. The numbers is right here. 33 point. You see it right there, right? It's right here. You could look at it here, 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 and there's the numbers right here. Free cash flow. Okay. So I'm unfortunately I am not. I don't have time. Sadly, I'm going to be in the hospital. That's no, yeah. I appreciate your 3D machines. I mean, it's very beautiful. I mean, this software is amazing. It's crazy shit. You can export it, so you can export this table, and you go down, you go down here. And this is the exported table. Is how it looks like. Look how beautiful it is, right? I was highlighting this, I think, when I exported it. You see? I was highlighting it. So that's why it showed up as highlighted. Pretty cool, huh? Right? And I think I pressed this. This was pressed. You see how that's pressed? Let me unpress it. You see that now it looks a lot better. So then now let me export it. And now it's not going to have this shading. It's not going to look weird. So now let's see. Look at that. You see it doesn't have the shading? It's all software, guys. It's all software here. Okay? And again, you can get access to this software, and you can get access to it at a very cheap discount by using our coupon code below at alstocktrades.com. So that's the beautiful part about this, guys. And I think that's kind of where we're at. So now that we can see this, let's just use this 33.29%. Sorry, 33.29 million. And let's look at this simulator. And let's start it here. And let's do 2020. We'll start the simulation in 2024. And we'll do the average free cash flow is here. We're going to grow it at 23%. And we're going to go ahead and we're going to, start the simulation here. And you can see the stock price goes down, up and down. That's what works. And we're going to go, you can see this literally is following the stock price. It went up to like $3, right? You can see here, $3. It's very beautiful. So now it's doing the simulation. I'm going to run it really quickly. So I'm going to 4x the speed. So it's going to run. Right now we're in 2027. The stock price, the intrinsic value is $5 now. And obviously I think the free cash flow is going to go up higher and higher and higher. I don't think it's going to be, I think it's going to be better than this, but let's assume what Clover is going to be like in the next 25 years. So you could see the intrinsic value is $25 now. But let's just continue running the simulation. Right? And again, this is all part of lifetime access. You get access to this. This doesn't exist in nature. I created this. So you could zoom out. You could see the intrinsic value rising, right? And this is a simulation of the stock price. I would focus more on the yellow line here. So you can see now the intrinsic value is $170. It's right here, $170, $200. This is in 2047, 2048. We're getting there now, 2049. Now we're at 2049. The intrinsic value is $360. So the intrinsic value is $160. So what would be the market cap? So if we do market cap and hit them, so if we go, we do the market cap. If we press the market cap button, we can see the market cap is $360 billion. Okay. The market cap is 360. So I'm sorry. This is intrinsic value. Sorry. So here, okay. I was reading the wrong thing. So here's per share. Per share is the y-axis. Okay. If we hit market cap, now you could see the market cap is the y-axis. So if we were to zoom in, and if we were to just kind of go all the way to the right to what Clover's might look like in the future, and so you know what I realized? That's why my brain's not registering this. Look at the outstanding shares. I put the outstanding shares as 1,000. That's incorrect. The outstanding shares is not 1,000. The outstanding shares is not 1 billion. The outstanding shares is 512 million. And even with that, Clover is still kicking ass. Holy shit. Clover's still kicking freaking booty. It's fine. Let me just go ahead and update this. Sorry. I'm going to reset this whole thing. I'm going to redo it. I didn't update. You see how the math's not mathing? I was pausing. I was like, this doesn't make sense. I was repeating myself. I was like, wait a minute. I'm doing it because remember, I wrote the equation. I can do the calculation in my head. I'm like, this calculation is not, it's because the outstanding shares for Clover, I didn't update it. So now let's go ahead, update this all over again, 33.29. And let's go ahead and update 23%. Let me make sure everything's updated right now before I, okay, good. Let's hold on. Oh, there it is. Okay, so now we're going to update it again. 2024, 33, 23. Okay, good. Start simulation. Increase the speed. Okay, there. Now the numbers make sense. You see, I was like, what the hell's going on here? Okay, so now we're increasing. Now we're in 2027. Now let's just wait until 2049. So hold on. Let the simulation run. And you can actually for the simulation include dilution too, but we're not doing that right now. So we're going to go ahead. The intrinsic value is updating and market cap's updating. I'm going to make sure I got everything right. We're going to go ahead and make sure everything's good. Okay. Intrinsic value should be relatively the same. Okay. This is assuming Clover is going to grow at 23%. I think it might be doing 10%, but you never know. So if we do this now and we switch it to market cap, you can see now the intrinsic value is $700. And I want to make sure that I didn't, yeah, okay, good. And I would say the growth rate's pretty high, 23% for 25 years is insane. But if we do the market cap, look at the market cap, $326 billion, right? If we were to just half the growth rate and say 10%, and if we were to just run the simulation again and just say, you know what, I want Clover to grow half. If Clover can grow 10% for 25 years or whatever, what is it going to be in the future? And I personally think they're going to grow more than that because Humana was growing 15 to 18% of their revenue. So I think it could definitely get to that level. Did I not? I didn't hit reset. Hold on. Let me reset it. Pause, reset, stimulate. Reset. Hold on, guys. One moment. Oh, yeah. So I have to reset it. Okay, let's reset it now. Okay, full screen. Reset. Okay, so then now let's go ahead and do simulate. Let's do this number.
33.29.
Let's do 10% this time. And let's do the
512.14.
make sure we do that correctly. Let's do 2024 and let's start the simulation, but this time do 4x. You can see it's only going down to pennies, right? So then now we're running the simulation. It's running effectively. We're growing it at 10% now, and we're being conservative. We're like, you know what, over 25 years, instead of doing 23%, let's do 10% because it just seems more feasible to grow 10% over a 25-year period. And I think we're going to get to the 25-year period stock price a lot earlier because we're not growing 10% now. We are growing 37 freaking percent. Okay. But let's assume 10% and let's extend that to 25 years. I personally like to do 10 years. Warren Buffett likes to do 10 years. But let's just do the 25 years and let's see where this is going to head out. It's insane. You could see with just 10%, which is insane, which is so low, $16 is the intrinsic value, right? And even then, this is it growing 10%, and you can see how crazy undervalued this is. I mean, the way it's growing right now, it's growing like it's going to be 10% forever, and that's obviously not the case. At this rate, 10% would be the intrinsic value would be $1, which obviously that's not right. It's obviously clearly not $1. So the point is if you run the simulation at 23%, you get a market cap. You get a market cap of around $300 billion, which is about double what Andrew Torrey was saying.
512.14.
And we could just go ahead and make sure we have it here. If we run the simulation for what we have now, we could see the intrinsic value ends up going to 300 something bucks. And then the market cap will follow pursuit. So we'll go ahead and run it. Or I think at this rate, the 23% will take us to around $700, which is a market cap around $300 billion. So let that run. Waiting on it here. It's crazy, man. How many years did we run, man? And within 10 minutes, we ran through like over 100, 150 years of different types of simulations. It's pretty insane. And you can see the free cash flow here is $3 billion. If you look at Humana, that's where Humana's at, right? It's pretty insane. So the intrinsic value is $700 dollars. If you hit market cap, based off of this, we should get at a market cap right around here. That's when we cross-act. So by 2045, we should get to a $150 billion market cap based off of this simulation. Now, why am I emphasizing 150 billion? It's because of this. Andrew Toy said this. This is from Andrew Toy. These are Andrew Toy's words. You go down, let's look at his words. I think people in that retail environment support and are willing to believe and bet on a grand plan. They want something audacious, someone who's going out there and saying, we're an incredible $150 billion company. They see Clover as being different, and we are different. That's a great thing, as opposed to when people say, oh, you're just a Medicare Advantage company. No, we're not. So that's 150 billion. Okay. And based off of these simulations, we're talking 2045. And that's about 15 years from now. $150 billion market cap in comparison to United is not a lot. United used to be $500 billion. Now, why am I saying it's still a lot, but why am I saying that? Well, here's Andrew Toy's comments. And it's funny. This is them, these folks trying to do what Clover's doing, but they haven't. Now let's go ahead and go back to Vivek's comment, if I can find it. If we go back to Vivek said, and I think he said this in 2022. Okay. 2022 or 20, I think it was 2022 or 2023. One of those years. He said that in 10 years, I strongly believe that it is possible for Clover to have made the biggest positive impact in healthcare while simultaneously accruing the largest market value in healthcare in excess of any healthcare company that exists today. So 10 years is, it's pretty crazy. Now, again, obviously, Clover went through hell. They had to remove themselves from ACO, the ACO. And really, they're starting the growth phase in 2025. So we can assume that those 2-3 years after he made this comment was just for them to reset. 2025 was the reset year. So 10 years from 2025 will be 2035. And the fact that this is 2045 and we're at 149 billion, 150 billion, you can see there, right there, 150 billion. It's interesting because it shows me that it's actually 10 years, it's 20 years, that's 20 years from now. Versus Vivek is saying 10 years. So what that tells me is the growth rate of 23% is too low, which means that they are seriously about to turn on the growth engines. And if you don't recall, Clover used to grow over 100%. Do you remember? I think at one point they grew 150%. They're freaking insane. So I think we're going to see some, which is kind of why I ran this 25 in our all stock trades terminal. I ran this to 2049 based off of what this is saying. The market cap here is 592 billion. Or that's the stock price, but that's the intrinsics here. We're looking at 350 billion. And this is where people are saying, well, you know what? SaaS can get them there sooner. And all this is without SaaS. Imagine you add SaaS into it. It makes sense what he was talking about. So what does that tell you, right? I am just using their Medicare Advantage data, and it's showing me, based off of what Andrew was saying, $150 billion is going to happen in 2045, based off of the numbers they're giving me now. $150 billion market cap, 2045. But he's saying in 10 years, 2045 is 20 years from now. So obviously, they are more bullish than the simulation. And that's because of this last comment. Oh, you're just a Medicare Advantage company. No, we're not. This $150 billion is not coming from the Medicare Advantage. It's coming from their future SaaS business. So what quote he's referencing here is not the Medicare Advantage side. No, ladies and gentlemen. I think it's the start of this. Examining opportunities to advance American healthcare through the use of artificial intelligent technologies. Witnesses Andrew Toy, Chief Executive Officer of Clover Health. I think they were referencing SaaS from a long time ago. That's all I have to say. I'll see you on the next one.